Good afternoon, Olivier Desbarres here, live from London. I have the pleasure today of moderating Spiva's live chat on the US economy and commodity markets, and have the honor of welcoming Jason Schenker, who is the founder and chief economist of Prestige Economics. Bloomberg News has recognized Jason's forecast accuracy in 36 different categories for economic indicators, FX rates, as well as energy, metals, and agricultural prices, and ranked him as the #1 forecaster in the world in 21 different categories. Jason has also authored a number of Amazon bestsellers, including on commodity prices. Jason, a big welcome. And let me start, if I may, with the fact that economic growth is proving very volatile in developed economies, including in the US and the UK. For example, US GDP growth was 7 times slower in the first quarter of the year than it was in Q3 of 2016. What, in your opinion, may explain these surprisingly large swings in growth rates? And how is this likely to impact, if at all, US government and Federal Reserve policy?
Well, Olivier, first, thank you and Spear for having me on here today. I think the most important thing is where growth is going on trend. And if we look, this slowdown in developed economies is something that the IMF was very concerned about. But if we look at where PMIs are, purchasing manager indices, especially for manufacturing, that are leading economic indicators of growth, those have been improving and accelerating, although the US ISM decelerated in April. The Eurozone manufacturing PMI has shown month-over-month expansions for 46 months. So, things are looking, I think, for a little bit better marginally. I think we're going to see growth trend higher over the next 2 years. And that's the baseline scenario for the IMF and other sort of major. Well, in the US, the first quarter GDP was exceptionally weak. There are a number of different reasons for this. Auto sales pulling back was one of the main reasons, but we also saw investment improve. Investment and as a line item of GDP in recession for most of, or a little more than through the end of 2015 and the first half of 2000. So we actually see now investments in consumer confidence is high and leading economic indicators look pretty good. So there is, I think, an opportunity to see from here any sort of change and shift. I think the volatility is probably somewhat behind us.
Okay, thanks, Jason. So you don't seem particularly concerned about these Q1 prints we saw in the UK and other mature markets. You think that, we're effectively seeing growth on trend. So if we kind of drill down into the US labor market, which is obviously a key component of that growth picture, the headline numbers are clearly very strong, but at the same time, workers' earnings are struggling to keep up with inflation. In a tight labor market, one would expect workers to have perhaps greater wage bargaining power. So is it a case that the US labor market is looser than perhaps we assume, or are hourly earnings about to start rising at a faster rate? And ultimately, how does this impact Fed policymaking and a market which seems to think that a June rate hike is a done deal?
Well, there are a few things to respond to, and I think the first is the jobs number for April, it improved to the levels that we'd seen in March. So March was very weak and revised lower. The April number hints that maybe the March number was the exception rather than the rule. So it was the March number which was revised downward. I believe it's 79 month. Is that the big no? I'd also say that this entire business cycle has been one of getting rich slowly. And so we've seen now the unemployment rate finally back at the level of 4.4% we haven't seen for decades. So we're now back at a level that we were at 10 years ago. It took us 10 years to get back. So it's been a slow recovery. It's been modest and wage quite tepid. We're up 2% year over year. It's a little bit like which is around 2%, but it's and could it trend higher? Yes, but it's been quite tepid and anything of a great concern for the Fed, which is why I think be on hold until September unless we see continued strong job gains and increases of inflation. There's less of an urgency for the Fed to pull the trigger now, especially following that weak Q1 GDP report. They're going to want to see improvements in auto sales, improvements in jobs, and they're going to want to see investment remain on an even keel. And right now, I think quite a bit strong because of optimism around corporate tax cuts. I think the risk to growth come from fiscal policy disappointment.
So I guess in this scenario where the Fed pauses in June, you've got a market that's pricing in roughly an 80% chance of a hike. So the market seems to think it's a baked-in deal. In your scenario, what happens to the dollar? What happens to equities? I mean, convention would tell us that if the Fed skips a hike, equity markets would rally. But does the market look at this as a sign that the Fed is more worried and that markets should be more worried than they are?
So a couple of things. So the first thing I'd say is that back in really through the end of February, there was only a 20% chance of a rate hike in March, and we had expected a rate hike in March. Also out of consensus, 80% on the other side of the trade, and it was wrong. And the reason was that year over year, core CPI was above 2%. That's the Fed's target. We were above the target. There was a risk of an uptick. Now, as we look, oil prices are under pressure, so that's going to take some inflationary pressures off. And as we look at growth, I think there's some concerns, especially with Q1, and I don't think there's the urgency to raise rates. So it is for a market that's priced in an 80% chance of a Jew come back in. That being said, they are going to be data dependent, and they're just not in a rush. If we believe the Fed's own forecasts, based on where they were, say, in September 2014, the end rate, the rate that we would have seen for the Fed funds at the end of 2016 would have been 267 basis points by the Fed's own forecast. So there are to acknowledge about the meeting their forecast and what the reasons they haven't met that, and the reason we've seen changes is dependent highly on where core inflation is. Now sitting at 2%, it's not a cause for alarm, and we really need to see that tick up. Even though the Fed raised rates in March and it was a huge surprise, the dollar peeled off really here. So even though there was a rate hike, the dollar weakened. The dollar weakened because the story, the narrative for other economies has become more hawkish from a monetary policy standpoint. I looked at the Fed and I was to ask you how many rate hikes you'd expect between now and the end of next year, you would probably tell me something like 6, 7, 8 rate hikes. If I were to ask you how many you're expecting for the European Central Bank, that number's probably a lot closer to 0. So the truth is that there's probably an underrepresented and a way too dovish set of expectations for the Bank of England and a number of other central banks. The truth is that you're going to need monetary policy tightening coming out of there as well, and that's something that's going to shift the dynamic. I expect the dollar will weaken on trend.
So in this scenario where perhaps the Fed is not in a rush, other central banks are hiking, or at least the expectation they're going to hike becomes more real. Growth is broadly on trend, but again, inflation is not really worrying us. What does this mean overall for the so-called reflation trade, right? The idea that President Trump being in power equates higher S&P 500, stronger dollar. That's obviously come unstuck in the past couple of months. What would it take for that reflation trade, as it's commonly known, to spring back to life? Or conversely, what are the risks that this reflation trade really comes off the boil in a more serious way?
I don't think this is a reflation trade at all. I think the trade since the election is based on valuation expectations. When we talk about public companies, we talk about the market cap, which is the price of per share times the number of outstanding shares. But private company valuations are calculated using a DCF model, cash flow model. Important plugs in that model are a tax rate. If that corporate tax rate goes from 40 to 15, the value of the companies becomes greater. And so if you're doing M&A activity or you're doing valuation work, you've already been plugging in more favorable tax rates based on expectations of corporate tax cuts. So it's not a reflation trade, it's a revaluation trade predicated on lower corporate tax rates. If those corporate tax cuts do not come, there will be a very big in the public markets. If it does come, you're going to see some more upside because every company in the United States will become more valuable by a definition of valuation. It's not because inflation is going up. We had variation for over a year and a half because oil prices collapsed. They've been rising on trend since April of 2016, and we've seen a trend of higher lows up until last week when the Chinese PMI, which is a measure of Chinese growth critical for oil prices and industrial metals, slumped back down much closer to 50, which is a break-even level, the lowest level of Chinese manufacturing growth month over month in 7 months. Spanning since a Chinese manufacturing recession, which had been going on for about 18 of 19 months through June of 16 ended. So basically, through June of last year, there'd been a Chinese manufacturing recession going on. That ended. That was very supportive for especially industrial metals, but also oil prices. And now you've seen the Chinese economy is a bit more in focus. It's not the developed economies that's the problem. The question is, does China continue to grow? And then, of course, the second big question is, for equity markets, do these tax cuts come in? Because inflation is probably going to be very slow coming. Well, you know, Olivier, for I see the question coming in about will Trump get his corporate tax cuts? And, you know, I think something that's been positive for equity markets last week is the movement of the first phase of a healthcare reform bill through the House of Representatives in the United States. This is supportive of expectations that some kind of budget deal will get done. Maybe not all the tax cuts, maybe not all the extra spending, but some level of action will get done. That could engender inflation next year, but not necessarily for any other reason than that the government's just spending more money. I think that's more for next year a concern, but again, the extra spending will be offset by higher Fed rate policy.